Hi, my name is Michael Kelly. I'm CEO of Parkview OZ REIT, a new fund being sponsored by Parkview Investments. In this video, we'll give you an overview of the fund. We are set up as a qualified opportunity fund REIT, so our investors will be able to defer and potentially eliminate capital gain tax liability through a diversified commercial real estate portfolio. We know that many investors have faced hurdles as they tried to access these tax incentives. So we've worked very hard to make this fund as accessible as possible. The result is a fund that offers the liquidity of freely tradable shares of stock. We've eliminated the investor accreditation requirements. We have a much simpler path to filing taxes than partnerships. We have a low investment minimum and low fees. This fund makes powerful tax incentives available to everyone, and it also allows investors to better control the timing of their investment, which, as we'll discuss in this video, is key to maximizing these benefits. Parkview OZ REIT offers a great way to create low-cost, tax-efficient portfolios for yourself and your clients. So let's get to it. So as I mentioned, we've tried to make the fund very easy to invest in. So we've gotten rid of the accreditation requirement. We've kept the minimum investment low. For anyone who invests, you're going to be able to get the ownership of the commercial real estate portfolio. You're also going to get the qualified business income deduction. We'll talk about that in a little bit, but that can reduce the tax you pay on our dividends. One thing to keep in mind, though, is the qualified opportunity fund benefits. Generally, the IRS is going to require you to have, they are going to require you to have a capital gain, but they'll generally require you to have reinvested that into a qualified opportunity fund within 180 days. There are exceptions to that, so you want to check your individual situation if you're beyond the 180 days. But that's one thing to keep in mind, that these benefits are for capital gains that are fairly recent, and most of the benefits go towards long-term holders. So these first two these are the benefits here. The first two benefits go towards your original capital gain. So if you sold cryptocurrency, or you sold a stock or a vacation house, anything of that nature, you can get these first two benefits by you can defer your tax liability until December 31st of 2026. The tax will be due in the spring of 2027. And the second benefit is that once you've held it for 5 years, the qualified opportunity fund investment, you get to elect to step up your cost basis by 10%. So that eliminates 10% of the principal that you owe. So I like to think of it as a loan from the government, which is for 5+ years. So you get to keep using your money and earning more money on it with 10% principal forgiveness. So that's a pretty good benefit of the two of those combined. But the biggest benefit by far is that once you've held the Qualified Opportunity Fund, the QOF, for 10 years, you can eliminate all capital gain liability for that. And this benefit goes all the way out to 2047. So you can compound your growth without any capital gain liability for 25+ years if you want to. It's an incredible wealth creation machine. The other benefit, and the other big change that came out of the Tax Cuts and Jobs Act, was the QBI, the Qualified Business Income Deduction. And that's going to, for our shareholders as a REIT, when we pay out income through our dividend, which will pay out 90% plus of our income through our dividend, you'll be able to reduce your taxable income by 20%. And your tax savings will wind up actually being more than that, because it's your highest tax rate, 20%. So your actual tax savings will likely be more than 20%. So how do the qualified opportunity funds benefits affect returns? Well, you see a lot of presentations from CPAs and lawyers, and even when I do the numbers myself, For an investment that is returning, say, 7 or 8% per year, fairly standard commercial real estate type return, the benefits will add about 3% per year to that return. So your 7% becomes the equivalent of a 10, your 8% becomes an 11. It's a big benefit. And I come from the institutional world where if you're beating your index as a money manager by 0.5% per year, you're going to do extremely well. And if you're missing your index by 0.5% consistently, you're going to go out of business. So to have 3 full percent per year is an absolutely huge and very generous benefit that the IRS is giving you. It gives you an extra roughly 40% more that your money is returning to you. So it's really amazing. And as I mentioned, that compound growth, tax-free, eighth wonder of the money management world, it really is a substantial benefit. Now I was just talking about the benefits at the federal level. There's also benefits at the state level in many states. As you can see from this map, there's only 4 states that don't comply with the Opportunity Zone rules: Massachusetts, North Carolina, Mississippi, and California. And there's several other states in sort of that yellowish orange, which don't have tax, although Washington State just passed one for 2022, so we'll have to update the map. But keep in mind where you live, you may also have state or local benefits from QOF investment as well. So these are the ways we try to broaden access. Keep the minimum low, get rid of the accreditation requirement. Partnerships give you K1 tax forms, which can be a real headache. They're difficult to deal with. They are notoriously late because they're difficult to deal with for everybody. So even the companies have trouble getting them out on time. And you can get multiple K1s. You can get them where you live. And if the partnership has a project elsewhere, you may wind up with a K1 in that location as well. As we're a corporation that's electing to be taxed as a REIT, so for us, you get a 1099 DIV form, just a much easier form to deal with. Investor liquidity, unlike partnerships, which often have lockups, we have none of that. Your shares are freely tradable. You can go in and out as you please. The exit timing is up to the shareholder and not the fund. And that is a really critical element, being able to control the timing of your investment. Because if you plan to be a long-term investor, which you should if you're going to go for the biggest opportunity zone benefits, but life changes and you'd like to have the money back in the 3rd year, well, that's difficult to do in a partnership, but with us, it's not a problem at all. And the reverse is true. If you're in year 12 of owning this and you're loving the compound tax-free growth and the fund is scheduled to liquidate, there's really nothing you could do. With us, you could just stay and not sell the shares. The fund will stay compliant and you can enjoy that tax-free compound growth all the way out to 2047. Keeping the fees low is essential. We have no sales commission. We charge no acquisition or disposition fees, no investor service fees like you see with a lot of partnerships, and the management and carried interest fees. Partnerships famously charge often 2 and 20. We've cut that dramatically. Our management fee is less than half of that 2%. It's at 0.75, so less than 1%. And our carried interest is only a quarter of the typical 20%. It's 5%. Additionally, we're a public company, so we've got public company transparency. We have to periodically file with the SEC our financials. So you're going to get much better view of what's going on with the company than you would in a typical partnership. We'll pay out over 90% of our income through dividends as a REIT, probably close to 100%. And as a result, you'll get that qualified business income deduction, which is very helpful. And also you won't have the double taxation like you would in a corporation. REITs are effectively taxed like partnerships, but without the restrictions. So our investment strategy, value-driven and diversified. So we look at these tax benefits, and most of them are only worth something if you have a capital gain. So you have to be very careful to buy things at attractive prices. So we do a lot of valuation work and due diligence. The other element I would add is that we are long-term holders ourselves. So some funds you'll see trading properties, but when you do that, the actual fund has to pay capital gain tax, and that amount of money is no longer sheltered under the QOF. So it's really the benefit of the shareholder that gets to shelter themselves from capital gains. The fund, if they trade a property for another one, the capital gain amount would not be eligible to be reinvested in the fund. So it makes a lot more sense to buy and hold, because all of that is then sheltered and not liable to taxation. So we're going to be long-term holders. We're controlling project risks. You want to keep leverage at a limited level. Permitting, we want to do things that the community wants. We're not looking for permitting fights. We're trying to help, not hurt, with these communities. And we're looking to be establishing partnerships with local developers. I'll talk a little bit more about that in a later slide. Diversification is important, both geographic and by asset. We're going to be looking at all sorts of different asset classes. We don't want to be pigeonholed in any one, because any of them can have a significant down cycle. So we want to be diversified. And multifamily certainly leads the list of attractive asset classes, but we will be spreading our chips around a little bit. And the same is true with geographies. We want to be spread out and not be subject to just one area or one state. And what we'll be looking for in general is areas of strong employment and population trends. So these tend to be areas that are warm weather and low tax states, but not exclusively. There are certainly areas here in Boston and other places that have very attractive local economies that we could see growing for a long time. But that's the key, to see long-term growth trends in whatever area we're investing. So where are we going to be investing? We're required to invest in opportunity zones, which are low income areas. They're census tracts, which not many people know what census tracts are. They're not like zip codes, they're a little bit different. Typical population is 2,000 to 8,000. They tend to, or they can be full towns up in more rural areas, and in cities they're just neighborhoods. One of the interesting things about choosing these was that not all the eligible areas got designated as opportunity zones. So the governors were told which census tracts in their states qualified by the Treasury, but they were instructed to only choose 25% of them. They didn't have to choose the worst 25%, they could choose any 25% of these qualifying areas. And the reason the Treasury did that is they wanted money to go into, not be spread out too broadly. They wanted a lot of money to go into a few places to try to hit critical mass to kickstart the economies of these locations. And that's good for investors. It's terrific to be involved in places that are seeing a lot of expansion and a lot of job creation all at once. That's going to lead to some good economic outcomes. Across the country, there's more than 8,700 of these. It's really hard to picture what an opportunity zone looks like because they are so different from each other. Some have really bleak economic outlooks, and some look terrific. So there's plenty of good places for us to invest. This is an area I just wanted to point out as one that stands out to me. It's in the alewife section of Cambridge. I think it's really attractive, and over the decades is going to do extremely well because until recently, it started to take off recently, but it's been underbuilt. It has tremendous transportation infrastructure. They extended the Red Line, which is a major subway line, out from Harvard Square to Alewife back a couple of decades ago. And the area has been a little bit slow to take off, but it finally is now. The Red Line runs right past Harvard, MIT, Mass General Hospital, through the financial district and beyond. And all the buses are now emanating from Alewife, going out to the local suburbs. And there's parks and restaurants, and there's actually great roads there as well. There's a highway right beside it. So it's just a very convenient place to live, whether you have a car or not. It's just very transportation friendly. The infrastructure is substantial, and you're seeing critical mass of money starting to go in there. That's an area that's going to do very well over the next couple of decades. We want to position ourselves as a preferred partner. A lot of opportunity zone funds are typically real estate development companies or investment advisors or both. And we want to partner with these people because we think this symbiotic relationships, being able to partner with real estate developers is really key, because you're going into, for us, where we want to look at different asset types and different geographies. We don't want to try to learn all those different areas and expand as a developer into those different areas. That's a tough learning curve. We want to partner with someone who has built that type of asset many times and knows that local government and permitting setup and knows what to do to get the job done, and has done it many times and is well trusted by local officials. And the same is true on the investment advisor side. I feel that with our ability to defer and eliminate taxation, we can be a great tool for investment advisors to help them grow their business while they help us grow ours. So I think it's a great relationship, and not competing with either of these two entities is a key in positioning ourselves as a preferred partner and someone who's easy to work with and eager to work with is how we're positioning ourselves. These are some of our service providers. WTP on the legal side. STC is a transfer agent, so they'll be the ones paying out the dividends and keeping the shareholder of record. They've done a lot of work with public companies and in opportunity zone companies as well. And Novogradac is our auditor. They have done a ton of work in the opportunity zone space and overall in the tax credit and tax incentive space. I look at this as a holistic approach to wealth management. It's a great way to create tax efficient, low fee investment plans, whether it's for yourself or for your clients. It's available to everyone. And you know, the low minimum is really key, because no matter how wealthy you are, if for the QOF benefits, you can only invest recent capital gain funds. So if you've got a capital gain that is $40,000 or $70,000, that's well worth deferring. But for most partnerships, their minimums are $100,000 or $250,000 or $1 million. It's not going to be enough to get in. With us, we try to make it very easy, and those are our capital gains, where if you can keep that money working for you, you're going to be in much better shape. So that's one way that we help out. And the other is having the tradable shares, allowing you the liquidity. We look at this as a very long-term investment, but we definitely understand the benefit of having liquidity for everybody, whether it's to get out early or to stay in later than a partnership is planning to. It makes it work for the investor instead of doing what's best for the fund. And one thing I haven't talked a whole lot about is the impact investment side of this, which is that we're creating jobs and economic equality, which is one of the big issues in the country today. And to be able to help out in that regard with the capital flowing through this fund is something that I think a lot of investors and people will really appreciate. Controlling the timing, talked about that a little bit, so very important, and keeping the money working for you or your client. It is capitalism, so if you can keep that money in the account, keep it bringing in returns, that is incredibly important for having a good outcome. So how can you invest? You can visit our website, parkviewozreit.com, and there you'll find our presentation materials, offering documents, and our subscription agreement. The subscription agreement's electronic. You can fill it out quickly. Definitely encourage you to read the offering document and seek tax advice, because this is a very quick video and this is a very complicated topic.